Hello and welcome back to Radical Markets. I'm Galen. On episode 5, we're going to be talking about the stock bubble in China and what it means for the United States. Alright, so you may have heard in the news recently that the stock market in China has been crashing. It's down about 25% over the last few weeks. I'm sure some people are pretty excited about this over like Fox News, for instance, probably feeling like, oh yeah, America's #1, screw the Chinese stock market, this is awesome, best 4th of July present ever. This is a pretty foolish and childish reaction. Most economists would agree that the Chinese and American economies are highly interdependent and that bad news for China is bad news for the United States, bad news for the US is bad news for China. I would go one step further and say that it's not so much that the US and the Chinese are interdependent, it's that the US is completely dependent on China, or largely dependent on China. I don't really believe that the Chinese need us so much as we need them. That being said, bad news for China is definitely bad news for the United States. As most people know, stock market collapses correlate strongly with recessions. So we can expect that a stock market crash in China could mean a recession in China. Most people will accept the notion that Chinese make a lot of stuff that we can buy. And if there's an economic slowdown in China, that means they're not producing as many goods, which means there's not going to be as many cheap goods on the shelves in US stores at places like Best Buy, places like Walmart, where middle class people tend to shop. What you might not also have realized is that we're buying these Chinese goods using money that we borrowed from China. That might sound funny to you. You might be thinking, oh, I don't borrow money from China, I don't borrow money at all to buy electronics or anything like that. You know, I'm a responsible person, I save up for everything I want to buy. Like, this is garbage, the Chinese don't give me anything. Well, that's not true. The Chinese government buys 7.2% of US government debt. That government debt is being used to finance programs like Social Security and Medicaid. These are tax expenses that you don't have to pay right now because the Chinese are paying for it for you, with the expectation that eventually you're going to pay it back. Whether or not that actually happens is not really immediately important. What's important to understand is that the Chinese are reducing your tax burden by lending money to the federal government. The Chinese are reducing your tax burden and therefore allowing you to pocket more of your hard-earned money, which a lot of people are then turning around and spending on Chinese goods like televisions or other kinds of electronics. Personally, my computer is a Lenovo, which is a 100% Chinese computer. It was designed in China and made in China. So if you're a little lost now and you're thinking to yourself, alright, the Chinese loan money to the government, and maybe I spend some of that tax savings on Chinese goods, but how does this all get back to the stock bubble? Let me dive into that for you so you understand. As most people know by now, recessions mean less wealth to go around. That was true for the United States following 2008 and could be true for China now. If China were to have a decline in wealth, that would mean they would have less money to loan out to the United States. A recession in China will mean that the citizens of China will be more impoverished and they're going to need more assistance from the government. The Chinese government is going to have more pressure on them to spend their revenues on their own citizens as opposed to lending money to foreign countries like the United States. 7.2% of all federal debt, that's the $8 trillion sum that you hear about on the news, is held by China. So China owns about $1.3 trillion worth of debt. If the Chinese were to stop loaning to the United States because of their financial problems at home, we would have a shortage of loans in order to pay for our federal programs. This will mean that the United States will have to raise interest rates in order to attract more borrowers. But as I talked about in the last video, raising interest rates means larger interest payments on our national debt. Higher interest rates on the national debt mean that we're not going to have as much money left over to pay for our federal programs like food stamps, Social Security, so on and so forth. So how likely is this scenario? How likely is that the Chinese will go into a deep recession that has repercussions for the United States? Fortunately, there's evidence that it's still way too early to call game over on China. Though there has been a 25% stock decline, it should be considered that all of these gains were made in the last 6 months. The Chinese stock market is still positive on the year. If you invested in Chinese stocks in January, you're still doing okay. This is in sharp contrast to when the United States had its financial crisis. The drop in the Dow and the NASDAQ put the US stock market at 7-year lows. Stock prices hadn't been as low as they were in 2008 since 2001. So if you consider that the stock correction has only corrected 6 months of gains, you can kind of think of that as saying that the bubble in stocks in China only lasted 6 months. This is much better than the situation in the United States in 2008, where the bubble in housing had been developing for 7 years. In 7 years, a lot of houses were built. That was a lot of malinvestment, where resources were poured into a sector of the economy where there just was no demand. Now, in China, we can imagine that probably a similar thing has happened over 6 months. So a lot of the biggest gains in China were in tech companies, and so probably a lot of entrepreneurs invested money into starting up tech businesses during this 6-month period while valuations got really, really high in the stock market, in the hope that they would be able to list their tech company on the market and make a killing. But it was only over 6 months, whereas the real estate crisis had developed for 7 years before it popped. So the amount of damage that this stock bubble has done is probably a lot smaller than what our stock bubble did in the United States in 2007 and 2008. So to wrap up this video, I just want to say that this particular correction in the Chinese stock market is not as bad as what we had in 2008, and is not likely to by itself trigger a global recession and cause interest rates in the United States to rise. So while I don't think that the stock market correction in China is as severe or as important as what we had in the United States in 2008, it is important to remember the phrase about the straw that broke the camel's back. There's a lot of problems out there in the world right now, and this is just one more. Could it be the problem that triggers an interest rate rise in the United States? It could. It's really hard to predict exactly what it will be. It's not hard to know that it will happen eventually, however, because the national debt is just unsustainable. Eventually, some of our creditors are going to realize this and start to back off. Whether or not they realize it on their own, or if there's an event like what's happening in China where they just simply can't afford to lend to us anymore, creditors will stop lending to the United States. Alright, so thanks again for watching my show. This has been a great episode, I think. If you agree, please like and subscribe. Leave a comment below. I'd really appreciate some feedback as to how you think the improvements are going, the tripod, do you like the map behind me, that sort of thing. So yeah, thank you again for watching, and I'll see you next time on Radical Markets.